First of all, let's get into Bank of America, the numbers that they reported this morning. Good, bad? How do you feel about the numbers?
Good morning. Alexis, I think when you look at a lot of the banks, the expectations that Wall Street analysts had, they're traditionally high on the upside and traditionally low on the downside. And the expectations for most banks have been abysmal. And when banks come in a little bit above, or in this case, much higher, certainly they've been well received. And that's part of the reason why we've seen a rally in these shares. I think these companies still are not in the clear yet. There's still substantial economic headwinds in front of them. I think many of these institutions, though they have rallied, their fundamentals still give me a little bit pause for concern. And I would urge investors that if you are going to invest in these, be cautious about them. It's not all upside here.
Mark, you're shaking your head. Is that because you agree or disagree with Matt?
I largely agree with what Matt said. I think the issue is when you look at the earnings, you have to look at whether those earnings are sustainable, number one. And number two, you have to look at really where are the earnings coming from today. And if you look at this, largely trading activity and largely mortgage origination. Okay? If you look at credit cards, if you look at commercial loans, it's not coming from those areas. And in fact, default rates are up and the economy continues to rising, yes. And the economy is continuing, even though we've seen some fundamental signs that the deterioration has started to slow down. We're still in a shrinking economy.
So, Chris, if that is what it is, and we know today that perhaps the Treasury Department would consider converting preferred shares into common, is that a reasonable way to add more fuel to the fire? Because for every dollar they convert in preferred to common, it could put as much, their estimates are, as $100 billion of working capital into these financial institutions. Is that a cure-all?
It's not a cure-all, but it's a step in the right direction. And the reason is twofold. First off, as you said, more working capital. That's a good thing. The second thing is that analysts are increasingly focused on tangible common equity, and that would improve the TCE position of these institutions, which means that shareholders would be more comfortable in those stocks. And that's one of the goals of Treasury, which we've sort of forgotten, but is to stabilize these banks on the exchanges.
You know, Matt, my feeling about it as well is that if you look at the preferred size dividends that these companies are paying the U.S. government already, I could see, look, plenty of these financial institutions saying, I don't want the government involved in my common shares. I want to pay back the preferred and I'm out. But for those who remain, what's the downside to agreeing to a conversion from preferred into common?
I don't think there's much downside. I agree with your earlier point that I think these banks should do everything possible to try to get out of the government's thumb. I think when you look at the recent news that the government is reconsidering certain caveats that they will allow which bank to get out and for what reasons, whether it be systemic, whether it be good of the economy or whatnot, it shows to me that the government is not essentially the best business partner. So I think twofold, if the institutions that are involved with the TARP can find a way to get out of it, that is certainly going to be accretive. Secondly, if they can find a way to convert this and get more money to lend, that's great. And the last thing is, let's not forget, is that energy prices are lower with gas roughly at $2 a gallon. That puts money directly into the consumer's pocket, which allows them to spend more, and it also allows them not to take on more debt.
Yeah, you know, I'm so glad you made that point at the end, Matt, because, Mark, I've had a lot of arguments with people about this who say the banks are not lending. They're not lending. They've been given taxpayer funds. They're using it all for acquisitions. And I keep saying to people, that's just not true. I mean, first of all, when we're in a period of recession, people tend to take less credit because they want to pay down debt or actually want to save money. So I kind of feel like this Wall Street Journal article today, and this was out of a Treasury announcement, is once again saying, oh, these guys are all bad guys, and they're not doing what they were supposed to do with the funds. But, you know, clarify this for me. Am I over the top? Is it true? What do you think?
I think you're not over the top, but I think as the economy has continued to get worse, you find less and less creditworthy borrowers, both from a commercial standpoint and from an individual perspective. So I think the banks want to put the money to use. That's the business that they're in, but they're not finding people who they feel are worthy credit risks at this point. And I think you're going to see a lot of that. Can I go back to something that Matt said about the government funds and about taking the money and basically converting into common shares? It's a good idea. I actually think it's going to be necessary, and I think the bank's going to have very few options. Some of these banks, after they go through the stress test, are actually going to be in a position where they're going to need capital, and it's going to be very difficult to find it. In addition to that, I think the government is not going to be in a position, particularly the Obama administration, to go back to Congress and ask for more TARP funds. So I think this is a way for them to get around that.
Yeah, I was just going to say, Chris, I mean, this is sort of their way of not asking for the additional $250 billion that they initially talked about, particularly when they're announcing today that they've got to cut $100 billion out of spending over the next couple of months. It's one of the first things Obama said they need to do right away. What does this say, though, about the future longevity of their ability to be healthy? I mean, those stress tests are just a couple weeks away. If they can convert this into common equity, if they can stop paying egregious dividends, I mean, 5%, the government's making some decent money as well at the rate that they can print that money. Can we turn the corner?
Yeah, I think we can. And one of the messages that was loud and clear in the earnings that have come from the big banks that have reported so far is that, yes, the losses are deteriorating in quite a few lending sectors, but they also have stronger earnings in other areas. They're growing revenue elsewhere. If they can add to retained earnings by not paying that big dividend, that helps too. I think we're a couple of quarters away from a much more solid banking system.
All right. Well, I think 2 deals on a Monday morning that could help, 2 mergers and acquisitions, some investment banking revenue. Mark, Chris, and Matt, great having the 3 of you here today. Thank you guys so much. All right. Coming up, more outrage. Congress is planning to tax you on things you buy on.
I'm joined by Mark DeGennaro, Managing Director of Grupo Levy and Company. I can't think of a larger one percentage-wise. The street's looking for 4 cents. They come in with 44 cents, and they beat on the top line, yet the stock is down.
Stock's down for a lot of reasons, I think. If you look, there's a question about management at this point, as you know. There's a question whether the company is going to have to raise capital going forward or not. So there's also a question about how the Merrill Lynch acquisition is ultimately going to play out. So a lot of questions, a lot of things hanging over Bank of America's head.
Do you think that the street is now rethinking all of these earnings from all of these financials?
I think if you look at the earnings to date, they're coming really from 2 sources. One from mortgage lending, and the second area is from fixed income trading. And I think if you look across the other businesses, you heard Connell's statement earlier about the fact that credit quality has continued to deteriorate, default rates are going up. So I think they're starting to look and say, okay, how sustainable are these earnings?
So you mentioned the management questions at Bank of America. They've got a shareholder meeting coming up here in about a week. What do you think the outcome of that's going to be?
It's too close to call. I think there's probably some momentum for splitting the chairmanship and the CEO position. That seems to be very common at other companies, so I wouldn't be surprised if that passes, but too early to tell.
Now, there's a lot of talk out of the White House that maybe they won't have to go back to Congress for more money, but that some of these banks still need to get more money, and of course there's a stress test. How is this all going to play out? Because it's been very confusing from the very beginning.
It has been. There's so many government programs with so many acronyms, it's hard to keep track of them all. But I think the way it probably plays out is that the government now has loans to all these institutions. What they'll do is simply convert those loans to common equity. It'll help the company's capital position, and most importantly, the Obama administration will not have to go back to Congress and ask for more appropriations.
But let's say Bank of America needs more money. Where do they get it from?
Bank of America, well, they have 2 choices. They can go to the capital markets and try to raise it from private investors, which may be difficult with some of these things hanging over their heads, or they get it from the government.
Mark, are there any of the financials that you would buy right now today?
I think it's tough. I think something like a Goldman Sachs still looks pretty good. They've got a solid management team and have seemed to weather the storm more than others. But there are others that I think still have some period of time where there's going to be a little bit of shakeout here.
And, you know, Goldman actually put a sell rating on Citi this morning.
I'm actually not surprised by that. I mean, if you look at Citigroup's earnings, I think you have to break it down. And again, mostly fixed income trading, mostly mortgage origination. But in other areas, the bank did not look particularly strong. The consumer segment's weak. Loan default rates are going up. Credit cards don't look particularly good. So I think they've got some work to do there.
All right. Thanks a lot, Mark DeGennaro. It's very, very confusing.